Hey tax hackers, Miguel here. Now we're going to show you how to get into your tax numbers and do some tax strategy on your own.
And this is our overview of tax projections, and we're going to take you through how we would help you figure out how to create your P&L, how to estimate your taxes, and third, how to put some tax strategy on top of that. So the first thing that we look at when we sign on a client is we have a intake form. Oftentimes we're asking pretty basic questions up front. Tell us about the unit. And this client has a single family home with an in-law studio. That helps us understand, is this a full-time rental? Is this somewhere where you live? Do you spend time there? Do you spend the summers there? These are all things that from a tax perspective matter, because if you think about the business pie of expenses, right? Or sorry, the total pie of expenses, you can only take as a deduction a certain piece of that, depending on what your business versus personal is, right? So first we want to kind of grow the pie as big as we can. What are all the expenses? In this case, we have a homeowner, so it's going to be mortgage interest, property taxes, and we'll talk a little bit about depreciation, but there's all those expenses, including utilities, and we need to figure out, how do we slice that between business and personal? This helps us get there. So what you're seeing here is the description of what it is. Usually we ask for links. Sometimes it helps for us to actually see the unit. There's some benefit to us understanding what it looks like and what's all involved in your specific property. In this case, we have someone that bought a property mid-year last year, 2018, value from escrow statement. We'll actually validate this. Oftentimes clients don't include closing costs, so we do ask for you to give us the general amount, and then we'll work off of that, right? So personal use, these are kind of answers we get from clients. All rental use, most. Well, we interpret that, so we usually ask, hey, give this your best go. We'll figure out what that means. And what that means in this case is that they're saying, hey, it's a single family home. I live in the home and I rent out the in-law studio. Down here, we have the square footage. So we actually do like to have, because these back up our work papers, if there's ever a review, an audit, even by another firm, or if you want a bank loan, sometimes they'll ask, how did you come up with these numbers? This is how we come up with those numbers. So what you put here really matters. So, I've got here that 1,000 is exclusive. That tells me that the in-law studio is about 1,000 square feet. And then the total home is going to be 2,500. We've done the math for you, so it's about 40%, right? So in fact, that 40%, remember it will apply kind of throughout. So the 40% is important, but just note that we don't base everything on square footage. So before you pause this video and start applying 40% across all your expenses, just hold on. We'll explain a little bit about how it might differ. So below here we have what we call indirect expenses. So these are things that are going to benefit the whole unit if it is split. But what we ask here is for totals. When we're doing tax returns, we'll ask for the totals from the prior year, right? If we're working on projections, so we're trying to estimate what you're going to owe in 2019, then we're going to ask you to estimate annualized figures for 2019. You can see here it says, please provide annualized figures for 2018. Let's go ahead and update that, because this is a projections analysis. So we'll basically look at this, validate it across different information. For example, 16K in mortgage interest. Did that come from your estimate? Did it come from the Form 1098? We need to validate that, because of course it needs to match what was filed with the Internal Revenue Service. What's filed for mortgage interest is Form 1098. That comes from your bank, and it gets filed with the IRS. So we want to make sure that that is consistent with what we put on the tax return. So here, once we have all this, what we start doing is we start organizing that data into our Airbnb expense calculator. That's what you got here. We're basically dividing out, these are the deductible expense categories that we are breaking out for you. Generally, if you ever set up a QuickBooks account or a chart of account in Wave, this is how we would recommend you to kind of break it out, right? So you'll see we've got an expense like guest amenities. We want that broken out from supplies, which might be, amenities might be things that are directly for use by the guests. You know, I don't know if you leave out chocolates or, you allow access to certain, toiletries. Supplies is going to be more, behind the scenes items. So talk a little more about that. But the point is that you're going to go line by line to figure out, hey, are there any deductions that I'm missing? Of course, it differs for everyone, but point is we summarize that line by line. In fact, unit by unit. But in this case, we just have one unit. But for property managers out there, sometimes this list goes out to 8, 20 properties, and we're really trying to figure out how does profitability differ between each one and what's the tax impact. I'll talk a little bit about depreciation, but I think that would probably be a lesson all on its own. Depreciation is really looking at what is the total value of the asset. What can we depreciate? All right, let's depreciate that over the prescribed amount of time according to the tax rules. And then what's the business percentage of that, right? So it goes back to, hey, we've got this total pie of depreciation. We can only take 40%. So in this case, we take 40% of what would have been 466 divided by 27.5. That comes out to 4.8, 5K a year. So for this host, they're able to depreciate $5,000 per year against their income. So it's kind of like a head start. You already have 5K that you can do that. What else can you deduct? Mortgage interest, right? So if you look at mortgage interest down here, here's the 16K total you were talking about. Well, you can't take all of it. So let's take that 40% and apply it to the 16K. So just right there, what I've been able to show you is that with mortgage interest plus depreciation, you can make that much. That combines to 5 plus 6.7. We'll just call it, comes out to about, looks like it'd be about 11.5. Yep, 11.5. So you can make up to 11.5 tax-free. You have no tax, and that's before all your other expenses. Usually, there are tons of other expenses besides those. We're just saying that, look, if you spent nothing and you made 11,000, you would still show no income from a tax perspective. That means you've earned $11,000 in revenue, completely tax-free. Where else are you going to get that kind of return? Until you're not going to get in the stock market. The stock market's might going to give you a percentage, but you're going to get taxed on that. So just moving on. The point that we're trying to make here is the amount of tax write-offs is going to impact how much taxes you pay or get back, and that should be included in how you think about what the return on investment is for your Airbnb unit. So long story short, I'm going to kind of speed this up here. We've got depreciation. There's some other things here. Feel free to email me if you've got questions about that. But once you have your depreciation, your expenses, you're going to see it flow into a P&L, right? So we've basically constructed based on Airbnb gross payouts. Oftentimes, we're also looking at clients that have VRBO or do use booking.com. Again, that's all going to go up here. And then we've got the deductions broken out the way that we talked about, right? So at the end of the day, this client had 31K of expenses off of 20.5 in revenue. That's going to come out to an operating loss of about 11K. So how does that impact my taxes? That's kind of the question. Okay, so what? I've got that. Well, what's important to note is that oftentimes 99% of all clients have some kind of a pass-through treatment on their Airbnb, meaning that they either are a sole proprietor in this regard or an LLC or sometimes an S-Corp. Rarely an S-Corp for this type of model. Just want to be clear. If you've got a paper loss, probably don't want to be an S-Corp. There's reasons for that, but again, that's kind of out of the scope of this video. But the way it impacts your taxes is you've got to look at what you're doing outside of the Airbnb, right? Because at the end of the day, it's a pass-through entity. So what, right? I lost 11K. I'm going to ask a question. So what? Well, the answer to the so what question is going to be answered by looking at what your tax profile is without the Airbnb income first. So what we've done here is we've assumed a 250K W-2, right? A lot of our folks already have gainful employment, kind of a day job, right? And Airbnb is just something they found on the side. Again, there's different example cases. We have an example for property managers that do this full time. We have an example for real estate owners who own 5, 6 properties. This is just a small glimpse into what is actually 80% of the Airbnb market. 80% of the Airbnb market are homeowners who, if you just look at, not as a percentage of revenues, but if you look at as percentage of hosts, mostly are homeowners who are renting out a part of their home part of the time. So what you have here is you have someone with a W-2, and we're taking a standard deduction, just keeping it super simple. At the end of the day, someone's tax on 226 of income, no deductions, exemptions went away, is going to come out to 42,000, right? So that's the ordinary tax. It's about 19% as an average tax rate, probably much higher, probably a 24 marginal tax rate. That's going to be my guess. If you look at just basic W-2, nothing else going on, right? We assume that they withheld 16% of their wages. Not a whole lot, right? So that means they paid in 40. Tax credits, we're going to assume there's a kid here, right? So married, 1 kid. That means you get, the tax would have been 42 minus the 40 would have been about 2,800. But with this $2,000 credit, it comes out to about 800, right? So it's kind of break even. I don't think anyone in the 250 bracket would be surprised about 819 in taxes. But the point is, back to our question, I've got an Airbnb loss of 11K, so what? Well, if you're able to run it as a Schedule C, meaning that it's an active loss, the same way you would think about having a bed and breakfast, something that acts more like a hotel, right? If we consider it a business activity, meaning that we are actively engaged in marketing the business and messaging hosts and creating an experience, then we can treat it as active. So what happens when we do that is we bring in the Airbnb loss. So let's bring that back in here. So we're going to take 11K off of our total income. So we went from 250 down to 238, 239 about. That's going to bring our ordinary taxes down. Remember, it was about 42. Now it's 40. So what did that create? That created a swing of $2,000 in taxes. And you can see that reflected right here. So instead of paying in $800, now this client is going to get a refund of $1,800. That swing, that 2K, is basically what basically adds to your return on investment, right? You were able to pay $2,000 less in taxes because of your investment. So from an ROI standpoint, right, putting the money into getting your place ready, yes, you look at the 11K revenue. When you're calculating the ROI, you should also add in the tax savings that you get. And that's your true income stream from your business. You divide that income stream divided by your total investment, that's your ROI. So the point is that, yes, taxes matter because it has to do with how much taxes you pay in and how much you get back. But ultimately, it matters more from an investor perspective of what's my return on putting money into this business. And by the way, while we're talking about it, the return that you get from that business is more than just the financial, right? There is a reward of entrepreneurialism, a reward of doing something novel and interesting that a lot of our clients get. So just remember that while you're having all that fun, you're also winning from a dollars and cents standpoint. So we hope you enjoyed this video. We'll make sure that we are responsive to any questions we get about it. We should be showing an email to email us at if questions come up. Feel free to reach out to me personally.